So just as a bit of extra background, I work as an investment specialist across our emerging markets team here at JPMorgan. I've been here for 20 years, so I've definitely seen a lot going on in the asset class, a lot of changes, both good and bad, I think it's fair to say. And what I really want to do today is firstly remind you all about why we still believe emerging markets has a place in your portfolios. It's been very evident in the last couple of years that the story's really been about the US and US exceptionalism, the Mag 7. You will have all read, observed, and hopefully enjoyed some decent returns coming out from the US. But I think as the last couple of weeks in particular have shown, there's not only one direction in that US trade. And it reminds people the strength of what EM can bring by way of diversification to a long-term portfolio. So if I could move forward one slide, please. I've got 3 numbers up here. Don't worry, I'm not going to make this a pub quiz, but I did want to set the scene about the sheer magnitude of what emerging markets encompasses. So that 86, that is the percent of the world's population who live, work and consume in emerging markets. Clearly a huge number, over 6 billion people there. 41. This is the percentage of GDP contribution that emerging markets deliver by way of global GDP. So they give a strong contribution to the growth that we see globally. And understandably, that's led by the Asian markets, so China, India, Taiwan, and so on. And that 9.9, so you can see we're getting smaller, is the percentage exposure of emerging markets when we look at a world index. So when we look across all of the global equity markets together, understandably dominated by US, but EM is 10%. Now, I would argue for a lot of investors, they maybe don't even have close to 10% of their equity exposure in emerging markets. And as you can see, this is a part of the world that is hugely dominant by way of people, by way of long-term potential. So why have we then taken an income tilt on emerging markets? We've said it's a huge opportunity, there's huge growth. Any of you that have been on holiday and enjoyed going to many of our great markets will see not just the speed of development, but also the opportunity for that growth. If I could move forward one slide, please. Dividends is maybe something that isn't normally considered in emerging markets. As I said, people think about harnessing that growth. But dividends are a really good proxy for corporate governance. And I would always think about corporate governance as almost being a sign of trust, right? Paying a dividend is a sign of management wanting to work with you as a minority investor. If a company is able to pay a dividend, it's a sign that they feel they have a robust balance sheet, that they have sustainable earnings that they want to share with minority investors. And why we like dividends so much is because in emerging markets, what you maybe term as more Western or other manners of squeezing value out of companies doesn't work to the same degree. So takeovers, you don't really see that many takeovers, at least to date, happening across emerging markets. And you often find a lot of family ownership. So you don't see much by way of changing management teams where that can often uplift the valuation of a business. You can see on the right-hand side, if we look even just at activist campaigns across emerging markets, that number is quite low compared with other regions of the world. So dividends in emerging markets have almost been what I would term a silent revolution. No one thinks about the dividends because that's not what they naturally think of as emerging markets. But we've been running this product for 15 years this year. And what I would argue is over that time, and especially in the last couple of years, you've seen a huge growth in the dividend paying universe as more and more corporates across emerging markets recognize the signal that paying dividends sends to investors. So we've got a big universe. We've got more and more companies paying dividends. What are we trying to harness? Where does that actually land us? So if I could move forward one slide, please. What we're trying to do in the JPMorgan Global Emerging Markets Income Trust is look across the breadth of the investment universe. We want to be finding companies that can deliver a combination of income and growth, right? We want those dividends, but we also want companies that can grow, that allow our investors, our shareholders, the ability to participate in that growth that we continue to see driving the emerging market story. So when I look across the investment universe and we think about companies that are paying dividends, there are over 900 businesses across emerging markets that currently fit. Now, we have a very large team of individuals at JPMorgan dedicated to the emerging markets asset class. So they're spread in 9 locations across the world, finding us these bottom-up ideas, going out, kicking the tires, speaking to management and understanding what fits. And this is where I think it gets quite interesting. Because if I asked you to think about, right, what type of sectors and industry groups do you land in when you're looking for dividends in emerging markets or really any asset class? I would argue that at the top of your list, you're going to put sectors such as telecoms, utilities. What we actually find today is companies in pretty much every sector across emerging markets offering us that exposure to income and growth. That allows us to build a really diversified portfolio. So just as a flavor of a couple of those businesses, you have a white goods and appliance company. Now that probably fits more in your stereotypical defensive name, nice cash flow, ability to pay out dividends. This is actually a China A share business, a company called Midea, M-I-D-E-A. You may well have actually seen them in the likes of John Lewis and AO.com in recent years. They're growing their global footprint. We have one of the world's largest two-wheeler, so motorcycle manufacturers, a company called Bajaj Auto in India. We have a clothing manufacturer. So Shenzhou International make, in particular, leisure and athletic wear for the likes of Nike and Adidas and Uniqlo and so on. So again, names familiar to many of us in our daily lives. And then that final business, and this is where I think it highlights the sheer diversification of opportunity that we find in emerging markets. This is a gaming company. This is a company called NetEase, who have been growing their global footprint. They do a lot by way of multiplayer online games. They've really led the way in the last couple of years. And so we see a real breadth of opportunity, as I said, across basically any sector, across the largest asset class that we see. But what links all of these businesses and all of the opportunities that we own is superior corporate governance. It's management who are basically using dividends as a signal to say, we want to work with you. We want to share our profits with you as minority investors. So that's all well and good. But now let me move to almost the elephant in the room and the risks of emerging markets. So if I could move forward one slide, please, because you're probably sat there thinking, Emily, this is great. Sounds fascinating, but have you not been reading the headlines? Have you not seen what's going on in the world? And yes, we do, but that's part and parcel of our asset class. I would always talk about emerging markets being an asset class where volatility is inherent. That's why they're called emerging. They're called emerging because they maybe don't have the stability and the backdrop that other markets do. And what you can see here is probably some of the names that come to your mind around what I should be concerned about. Geopolitics, very obviously, especially right now with what's going on. Trump 2.0, he's already called out China, Mexico, who knows? There's probably more to come. We always see pressure in emerging markets from the Federal Reserve and where they are in their rate hiking or cutting cycle. You've got concern around China, and I'll come to that later because I actually think that's one of the good news stories, bizarrely, for this product in the last year or so. And then India, which has been capturing a lot of headlines. It's probably a market that you yourself looked into in the last 18 months or so. It's been having an incredibly good run until the last few months, but understanding how we think about that. This isn't any different though. At any point in any cycle, I would talk to you and raise probably the same points that you should be concerned about. But this is where I think investing from an income standpoint in emerging markets helps soften a lot of that noise, soften a lot of that volatility that we should always expect. I think the other point that I would always stress to you as investors is when you think about emerging markets in your portfolio, you should always be thinking in years, not months, right? That volatility there, we do exactly the same. We invest looking long term, actually looking on a 5-year basis, because we recognize that a tweet, a headline, some short-term move often has a more extreme impact on emerging markets. But ultimately, you want to be investing so that those fundamentals that we see, the strong corporate governance, the strength of the balance sheets, the ability to pay dividends, shines through and rewards our shareholders. Okay, so let's start to deep dive into the portfolio. And again, I'm going to mention that word diversification. So if I could move forward, please, one slide. I've mentioned several times diversification. It's hugely important that when we construct this portfolio, we're looking to really balance out where that income and growth comes from. We will see later on, we also balance out the exposure that we have by different markets. But why do we balance out that income plus growth exposure? Well, we always think that a high yield can actually be a sign of high risk. Right? Think through companies that you've maybe come across historically where the yield looks high, but you think, hang on, what am I not getting? Is that basically a value trap? So from the start, what we don't want to do is just be buying into a company because the yield is optically high. If I rank all of those 900 businesses that we cover within emerging markets that are paying a dividend, we actually only hold 6 of the top 50 names right now. It's very much about finding that balance. And when we think about the portfolio, we basically have these 3 buckets. So you've got your central bucket, 60% of the portfolio. These are companies that are delivering 3 to 6% dividend yield. And as a result, we would be expecting growth within the market. We have an example here, a company called Quanta in Taiwan. They are known as an ODM. They are an original design manufacturer. One of the many things they do is they design and manufacture notebook computers, so laptops essentially. So if you're sat listening to me today on a Lenovo, on a Dell, or on an Apple, the chances are Quanta have had some involvement in your device. On the right-hand side, we have the higher yielding names. So these are names that pay in excess of 6%. We're going to be expecting maybe less growth out of those names, but they are helping balance out that income stream that we see coming through, which today for the trust is about 4.2%. And then on the left-hand side, you have your lower yielding names. So these are the names that by nature are still more at a growth stage of what they're doing. They're paying at least 1%, but they're still paying, as I said, you're expecting to see growth from the dividend and also the earnings, so the capital gains, the share price as a result. And the example we have here is Tencent, one of the largest e-commerce companies in the world, an internet company, who've actually only just started paying dividends in the last year and a half or so. And they're yielding about 1.1%. So great growth, great exposure to the Chinese consumer story, but that lower yield. So that's how we're building out the portfolio, right? We want to be finding companies across a very broad spectrum that have firstly the ability to pay a dividend, i.e. they're generating enough to pay it out, but also importantly, the willingness to pay. So we're then constructing a portfolio of about 80 names using those criteria. Okay, so where do we land? If I could move forward one slide, please. I'm just going to give you a fairly quick overview of some of the key markets and how we're thinking about them. Because again, this I think highlights where an income focus in emerging markets differs from a growth focus. So if you already hold a growth-orientated emerging markets portfolio, your overlap with this product is going to be fairly slim. This is a really good diversifier and complement, I would argue, to current emerging markets holdings. China has been in the headlines an awful lot. And I imagine a lot of the sentiment around China, despite the rally we've had in the last couple of months, is still quite negative. But from an income perspective, China has probably been one of the biggest shifts we've seen in dividend culture positively of the last few years. And I think part of that is understandable, right? You've seen a lower growth rate from the economy. You've seen struggles caused in many cases by the reduced consumer recovery and the low sentiment around China. And as a result, you've seen a lot of companies use dividends to try and encourage investment. you've seen a shift in what I would term the capital discipline, the capital allocations of management who say, actually, the world's changed. Our market's changed. Alibaba, you see here on the chart on the left, is a great case in point. It used to be a growth darling, right? If I was speaking to you 6 or 7 years ago, Alibaba was leading the way. It was doing fantastically well. Since then, you've had regulatory pressure. You had Jack Ma vanish, albeit he's now come back and is allowed to sit in front of President Xi in what appears to be a very visible and planned welcoming back into the fold. But Alibaba has been starting to pay dividends. And if I combine the dividends that Alibaba has been paying with the buybacks it's committed to in the next couple of years, it's yielding in excess of 6, 7, even touching 8% a couple of months ago. That for us is a really good opportunity to lean in, which is exactly what we have done. Now, the question you're going to then give me is, Emily, have you not seen everything about DeepSeek? Because the DeepSeek announcement saw the likes of Alibaba say, actually, with the new AI story going on, we're going to lean in and invest, right? CapEx, capital expenditure, we're going to increase. And the question mark then is, does this impact the dividends they pay going forwards? And yes, it might do. It might mean that the dividends that they're paying that right now are 3 or 4% might come down slightly. But I think what we've definitely seen from management is this recognition that paying back and essentially holding hands with minority investors is a really good thing to do. So China, more than just Alibaba, you see some names on the right there, has been a really good shift by way of capital allocation, capital discipline in China. And that's been something that we've been leaning into. Now, the other big market that we see in Asia that's caught the headlines is India. If I move forward one slide, please. And this is very different. India is a fantastic growth market. The problem we have for this product is it's yield poor. You can see this chart where we show the price earnings, so the valuation of the Indian market overall, and also the dividend yield. The dividend yield in India is very low. You can see at the back end of last year, it actually touched 1% for the entire market, which is probably one of the lowest global levels of any market that we see. So there are some fantastic businesses in India, but the issue for us is, firstly, they're quite expensive. And secondly, we're not getting much by way of yield contribution, which is what we want. And so what that means is for Gemi, we have a long-term structural underweight to India. We like the companies, we struggle to get comfortable with maybe what we're being asked to pay versus opportunities in Mexico, in Indonesia and South Africa and so on. So this again is why it works nicely as a complement from growth-orientated emerging markets funds who naturally would be leaning into India more. So great market, just one that today doesn't quite fit for us. And then just sticking in Asia, just over one more slide, please. The story around Taiwan and Korea. Right? I mentioned US exceptionalism, MAG 7. I think this is a great chart to remind people that for all the excitement around the likes of NVIDIA, it is born out of North Asia. Taiwan and Korea lead the way in semiconductors and memory, respectively. And that's really important because that's been a really good growth push that's come through. But within Taiwan, what additionally works for us in Gemi is the fact that there has been a long-term fantastic dividend culture. If I go all the way back to the early 2000s, Taiwan was probably the leader in the dividend culture across emerging markets. It was basically born out of the Asian financial crisis, where they recognized that in order to keep shareholders happy and invested in what were clearly very trying times, you needed to pay a dividend. And we see now a dividend payout ratio of about 40% in Taiwan, which is very high up versus pretty much any other market globally. So when you think about tech, remember a lot of that is born out of North Asia, and both Taiwan and Korea are fantastic hunting grounds for us from an income plus growth perspective. If I could move forward one more slide, I just want to bring some of the names to life. I'm conscious of time, so I'll just walk through a couple of these rather than go through everything. But suffice to say, there are so many opportunities across emerging markets of companies paying decent yields. You can see on the left-hand table the yield of the top 10 names that we hold. Samsung Electronics, one of the leaders in memory and consumer electrical items, you can see yielding over 5%. We have a bank in India. We have a Chinese gaming company. A company you may not have heard of, but maybe impacts your life, is the penultimate name on that left-hand table, Fuyao Glass. What are they? They are the world's largest automotive glass company. So the next time you get in your car, have a look to the bottom left or the bottom right of your windows, and it will be etched, the glass manufacturer. And increasingly, many more cars being sold across Europe and globally use Fuyao glass. So Chinese A-share company who've done very well, and as I said, become one of the global leaders there. The other two names I just want to highlight on this slide point to what the investment trust closed end allows us to do. And again, this I think is a really important differentiator. One of the beauties of investment trusts is that we can take more liquidity risk. We can lean in and look past the fact that we need to daily trade funds and daily trade on positions that we have to in the open-ended space and hold longer term positions. So you can see on the right-hand table, a company called Tisco Financial, which as the name suggests, is a financial services business in Asia. And then also OPAP. This is a Greek company, and it's essentially Greece's national lottery operator and scratch cards and pools and so on. By nature, you'll understand it's highly cash flow generative, and it pays an awful lot of that out as a dividend. They are small cap names. They are names you will not find elsewhere across our open-ended products. And this is why I think the investment trust is always a really good pure play on where the manager finds the best ideas, because you're far less beholden to liquidity. You're far less beholden to going up the market cap spectrum. And as I said, it allows us that differentiator. So how's that wrapped together? If I could move forward one slide, please. As I said, we have a long-term track record. This is now, pleasingly, our 15th year of running the Emerging Markets Income Trust. It works incredibly well as a diversifier to not just your emerging markets exposure, but also your income stream. It's yielding today just over 4%. That's a really nice kicker to your income portfolios and how they're constructed, I would imagine already. What it also has is a compelling performance profile. You can see, and there's lots of numbers on this slide, so if you look at the top table, the bottom line there towards the right-hand side, long-term outperformance over multiple calendar years. When I look at the annualized number, 3, 5, 7, 10, outperformance against emerging markets. We're showing that this slightly softer, more conservative approach to emerging markets that's also delivering an income stream can perform well with lower volatility. It goes back to that point that I raised around the continual risks of emerging markets, the inherent risks of emerging markets, which will always be there. But when you look at corporate governance, when you look at dividend streams, it softens your long-term exposure, provides a more pleasing and hopefully more compelling performance profile as well. And you can see that when we look at it by calendar year as well, that 9 out of the last 13 years, we've delivered outperformance against MSCI emerging markets with some really decent absolute return numbers in sterling. So one more slide, please. What do I really want you to take away from this? Firstly, don't write emerging markets off, right? We should always anticipate them to be cyclical. We all know as investors that markets work in cycles, but that's not a reason to take emerging markets off your radar. We find hugely dynamic businesses across the length and breadth of the asset class. And what we're doing with this product is harnessing those businesses with superior corporate governance. Companies where management have basically said, let this dividend be a signal to the market that we want to work with you. And we're able to do that through the strength and the expertise we have here at JPMorgan, one of the largest dedicated emerging markets teams in the industry, an investment manager, Omar Nagyal, who's been running this product and been involved since 2012. So we have great consistency and continuity there. and a product where we're recognizing that within emerging markets, there are actually some really positive shifts by way of the dividend culture. So what does this do? It allows diversification, is my headline to you. Diversification of how you see emerging markets, diversification of the income stream. And for maybe those of you that haven't yet felt comfortable enough to dip your toe into emerging markets, a more conservative way to start to get involved. With an asset class that is over 80% of the world's population. So let me pause there and thank you for your time and see if there are any questions.
Emily, thanks so much indeed. Yes, fascinating insight into emerging markets. And as you said, China being such a dominating feature of this, we've really got to start off with this, I think, if we can. A couple of questions come in. One particularly, it goes into the rest of the presentations we've seen today, and this idea of a trade war. China being such a big part of this, and as we've been hearing, really up against the big, tough tariffs that Donald Trump's issued, wants to issue its own tariffs in reply. How do you see all this developing, and what sort of opportunities, if indeed, does it create for investors?
Yeah, and I think that is clearly the big question, and the question that, let's be honest, no one knows the answer to. I mean, if I take you all back just to November or December, so just a few short months ago, there was narrative in the run-up to the election and on the campaign trail that there could have been 60% tariffs put on China. And so when Trump got in and started to roll out these tariffs that he'd always said were going to be one of his key things, 10%, you could argue, almost felt like a win. Now, the big question is, how do we think about that, and where do we think this happens? The first thing I would always point out is we don't try and position portfolios based off what we think might happen. We don't change anything in the run up to elections, nor do we try and change anything with all the narrative around tariffs, even though we knew it was coming. But I think when we consider China, firstly, a lot of the companies that we hold are more domestically focused, and those that are exporting, our analysts have been basically being very pragmatic with market share in markets such as the US. So we've already recognized that our numbers, we've sort of taken a haircut to, because we recognize that they might not ever be able to work with the US again, if indeed they were already. The second point is, there is a big school of thought that suggests that China can still be fully in control of its own destiny if it uses tariffs and refocuses itself, sort of pushes itself back to focus on its domestic economy and uses domestic stimulus. And this is where I think DeepSeek has been an absolutely fascinating development, because it's reminded investors globally that China hasn't vanished, that it still has huge technological insight and development power, and that in itself is opening up a form of economic stimulus. So I think tariffs, we could all sit here all day, worry what was going to happen next, and then wake up in the morning and Trump sort of done a 180. I'm not suggesting that will happen, but what we don't want to do is try and second guess. Instead, what we're focused on are finding the best companies in China who have the ability to pay sustained income, but also we see as benefiting from the consumer recovery, which is starting to gradually come through. So for us, it's about saying tariffs are there as noise. Let's keep focused on one of the largest economies in the world and the fact that's picking itself up from low points in the last few years.
Just one other question has come in. What's the dividend? Great presentation, by the way. This is part of the question, but a great presentation. What's the dividend yield of your trust? I don't know if I missed that, but I certainly didn't see it as a major part of your presentation.
No, you are exactly right. I mentioned it in passing, but I will also reiterate the fact it's currently 4.1%. I would always point out that as much as we see continued dividend growth coming through, this year we see dividend growth of about 9%. When I look across emerging markets, there has to be a translation effect taken account of. So 4.1% today, I would always argue it's about 4 to 4.5% through the market cycle. And again, let me just reiterate one of the real benefits of the investment trust vehicle, which is the revenue reserve, which allows the board to build up a revenue reserve and soften the dividends that get paid out to our shareholders if and when you see a slight reduction in dividends coming back from the companies that we hold. So again, another great tool that the closed-end vehicle allows us to do.
Okay, just wanted to follow up on that with a look at the overall performance. I want to bring in this next question, talk about it a bit more generically, because the question goes around the performance of the JPMorgan Global Emerging Markets Income Investment Trust against others in the market, there seems to be an underperformance. I guess you can measure against all sorts of different sorts of metrics, and I'm not completely sure where this question is coming from in terms of what they're comparing against. But how comfortable do you feel your portfolio is in this market at the moment, and how do you think it could improve itself given current circumstances that you said you work to?
Yeah, I mean, great question, great observation. I think we should all know that when you are in active management, there is no silver bullet, right? You can't outperform all the time. But what we're looking to do is offer that consistency of approach, but also recognize there are some environments that we're naturally going to struggle in. And I don't know the background of the question, but if, for example, you were comparing this against a pure India fund, India has done very well, at least until the last couple of months. But we, as I mentioned, are naturally underweight in India. So I would imagine optically it looks like we're going to struggle. Now, I would always argue the more diversified your investment universe, the more it sort of smooths out your longer term performance, whereas a single market tends to be a bit more volatile. It can be a bit more lumpy at times. In terms of how comfortable we feel, I think you can never feel fully comfortable because there is always news flow that could cause you concern in different areas. But all things being equal, we believe we have a very robust portfolio. When I look at the portfolio in aggregate, we have what amounts to really good characteristics. We have a group of companies that we hold with a return on equity of over a third higher than the MSCI Emerging Markets universe, and importantly, companies with lower leverage. That's important. That's basically telling me the companies that we hold in aggregate are generating higher profits and have got greater control about how they distribute those profits. And that's a really crucial thing for us. I think the other point I would always add is it's emerging markets. You have to be used to sitting on your hands. You need to be patient and allow fundamentals to come through, that at times the market just doesn't reward companies, even though you're looking at them saying, look, this is a really good business. And a lot of that is to do with sentiment, right? We've seen a real reduction in sentiment across emerging markets. The discount on this trust and other peers highlights that point. But we have to feel comfortable that the companies that we're holding can continue to do well. And that's definitely where we sit today.